Look, I need to be completely straight with you right now because what's happening in the gold market over the next 72 hours could fundamentally change everything you thought you knew about your physical holdings. And I'm not talking about some minor price fluctuation or typical market noise. I'm talking about a structural shift that's been building beneath the surface for months, and it's about to break into the open in a way that's going to catch most gold owners completely off guard. Here's what nobody's telling you. While everyone's been focused on the price action, watching gold bounce between support and resistance levels, there's been a quiet revolution happening in the physical market that's creating a divergence we haven't seen since the 1970s. And if you own physical gold right now, you need to understand exactly what this means for you, because the rules of the game are changing. Let me paint you a picture of what's actually happening right now. 3 weeks ago, I was talking to a dealer in Texas who's been in this business for 30 years. This guy has seen everything: the 2008 crisis, the 2011 peak, the pandemic panic buying. He told me something that made my blood run cold. He said for the first time in his entire career, he's seeing a two-tier market developing. Not just different premiums for different products, but an actual structural separation between paper gold and physical metal that's getting wider by the day. Here's what he meant. Right now, you can look at your screen and see gold trading at whatever the spot price is. Let's say it's $2,650 an ounce. That's the paper price. That's what the futures contracts say gold is worth. That's what the ETFs are pricing their shares at. But when you actually try to buy physical gold, real metal that you can hold in your hand, you're paying $2,650, $2,800, sometimes $2,850 depending on the product. That's not a premium. That's a completely different market. And here's where it gets really interesting. That spread, that gap between paper and physical, it's not shrinking. It's expanding. Every single week for the past 2 months, it's gotten wider. Now, you might be thinking, okay, that's just supply and demand, right? High demand for physical, premiums go up. That's normal. Except it's not normal, because at the same time this is happening, the paper market is showing massive short positions from commercial banks. They're betting against gold. They're saying the price should go down. But the physical market is screaming the exact opposite message. So what's really going on here? Let me take you back to something that happened in 1968 that almost nobody remembers, but it's the perfect parallel to what we're seeing right now. Back then, there was something called the London Gold Pool. It was an agreement between central banks to keep the price of gold fixed at $35 an ounce. They would sell gold into the market whenever the price tried to rise, keeping it suppressed. For years, this worked perfectly. The price stayed right where they wanted it. But then something started happening. Physical demand, particularly from France under Charles de Gaulle, started overwhelming the system. France was converting dollars to gold at that fixed price, draining the pool. Other countries started doing the same thing. The central banks were hemorrhaging physical metal trying to maintain the paper price. And then one day in March 1968, it just broke. They couldn't hold it anymore. The London Gold Pool collapsed, and within 3 years, the entire Bretton Woods system fell apart. Gold went from $35 to $850 by 1980. Now, I'm not saying we're in exactly the same situation, but the mechanics are eerily similar. You've got a paper market that's trying to dictate the price, and you've got a physical market that's saying something completely different. And just like in 1968, the physical market is going to win. It always does. Because at the end of the day, you can't eat paper. You can't hold a futures contract in your hand. When the music stops, physical metal is all that matters. Here's what's driving this divergence right now, and this is where it gets really critical for anyone holding physical gold. Central banks are buying at a pace we've never seen before. In the third quarter of this year alone, central banks added 337 tons of gold to their reserves. That's not just a big number, that's a record. And it's not just 1 or 2 countries, it's Poland, it's Singapore, it's China, it's India, it's Turkey. Countries that have never been major gold buyers are suddenly accumulating as fast as they can. But here's the thing that should really get your attention. They're not buying paper gold. They're not buying ETF shares or futures contracts. They're demanding physical delivery. Actual bars that get loaded onto planes and flown to their vaults. And when a central bank wants physical gold, they get it. They jump to the front of the line. Which means everyone else, including retail buyers, including you, is competing for whatever's left. Now, at the same time this is happening, look at what's going on with production. Global gold mine production peaked in 2018. Since then, it's been essentially flat or declining. The easy gold has been found. The big deposits have been mined. Yes, there are still new discoveries, but they're smaller, they're deeper, they're more expensive to extract. And it takes 10 to 15 years from discovery to production for a new mine. So even if we found a massive deposit tomorrow, it wouldn't hit the market until 2035 or 2040. Meanwhile, industrial demand for gold is actually increasing. Electronics, medical devices, aerospace applications. Gold isn't just a monetary metal anymore. It's a critical industrial commodity, and that demand is inelastic. A semiconductor manufacturer doesn't care if gold is $2,000 or $3,000 an ounce. They need it for their products, and they're going to buy it regardless of price. So you've got declining production, increasing industrial demand, and record central bank buying, all competing for physical metal. And on top of that, you've got investment demand from individuals who are looking at inflation, looking at currency debasement, looking at geopolitical instability, and deciding they want to own something real. This is creating a supply crunch in the physical market that most people don't fully understand yet. And here's why this matters so much if you already own physical gold. That metal you're holding, it's not just going to appreciate because the dollar price goes up. It's going to appreciate because physical gold itself is becoming increasingly scarce relative to demand. You're not just holding a commodity. You're holding an asset that's in the process of repricing itself relative to paper claims. Let me explain what I mean by that. Right now, estimates suggest there are somewhere between 100 and 250 paper claims for every ounce of physical gold in the COMEX system. That's not a conspiracy theory. That's just how fractional reserve bullion banking works. It's legal. It's the system. But it only works as long as most people are happy holding paper claims and don't demand physical delivery. What happens when that changes? What happens when a significant percentage of those paper holders say, you know what? I don't want a contract. I want the actual metal. The system doesn't have it. It can't deliver. And that's when you get what's called a squeeze. The paper price and the physical price completely decouple, and physical metal trades at a massive premium to paper. We've seen hints of this before. In March 2020, during the pandemic panic, there was a brief moment where you literally could not buy physical gold at any price close to spot. Dealers were sold out. Premiums were 20%, 30%, 40% over spot. The paper price was saying gold was $1,700. But you couldn't actually buy it for less than $2,000. That was a preview, a stress test of the system, and the system failed. Now, quick aside here, because this is relevant if you're thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, IRAs, 401ks, and you're concerned about this kind of scenario, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, how the storage works, what the rules are. Worth checking out if that's relevant to your situation. But let me get back to what's happening right now because this is time sensitive. The reason I'm calling this critical is because we're approaching a decision point in the market. The COMEX December contract is coming up for delivery. This is one of the biggest delivery months of the year. And right now, open interest is unusually high. That means there are a lot of contracts that could potentially stand for delivery, demanding physical metal. If even a fraction of those contracts actually demand delivery instead of rolling forward or settling in cash, the exchange is going to have a problem. Now, the COMEX has mechanisms to deal with this. They can raise margin requirements, making it more expensive to hold contracts. They can incentivize cash settlement. They can change the rules. They've done it before. But every time they do that, it erodes confidence in the paper market. It makes more people question whether their paper claims are actually backed by real metal. And that pushes more demand into the physical market, which widens the spread even further. This is a self-reinforcing cycle. And once it really gets going, it's very hard to stop. Because the more the physical premium expands, the more people want to own physical instead of paper. And the more people want physical, the wider the premium gets. It feeds on itself. Here's what this means practically for you as a physical gold owner. First, understand that the metal you're holding is becoming increasingly valuable, not just in dollar terms, but in terms of its scarcity and deliverability. If this divergence continues, and I think it will, physical gold is going to trade at a significant premium to paper gold on a permanent basis. That's not a temporary spike. That's a structural repricing. Second, if you've been thinking about adding to your physical position, understand that the window for buying at reasonable premiums is closing. Right now, you can still find physical gold, you just have to pay up for it. But if we get a real squeeze, if we get a scenario where the paper market breaks down, you might not be able to find it at any price. Dealers will be sold out. Mints will be backed up for months. The only gold available will be from private sellers at whatever price they demand. Third, and this is crucial, be very careful about the difference between physical ownership and paper claims. If you own shares in a gold ETF, you don't own gold. You own shares in a trust that claims to own gold. If you own a futures contract, you don't own gold. You own a contract that gives you the right to demand gold under certain conditions. But physical gold in your possession or in allocated storage where you have specific bars assigned to you, that's real ownership. And in a crisis scenario, that distinction matters enormously. Let me tell you about something that happened in 2013 that illustrates this perfectly. There was a German politician who started asking questions about Germany's gold reserves. Germany had 3,400 tons of gold, but most of it was stored in New York and London, not in Germany. So he asked, can we see it? Can we audit it? Can we bring some of it home? The response was shocking. The Federal Reserve said, sure, you can have your gold back, but it's going to take 7 years. 7 years to return gold that was supposedly sitting in a vault ready to go. Why would it take 7 years? Because they had to source it. They had to buy it in the market and accumulate it over time. The gold that was supposed to be there, allocated to Germany, apparently wasn't actually there in the form they claimed. Now Germany did eventually get their gold back. But it took years, and there were persistent questions about whether the bars they received were the same bars that were originally deposited or whether they were newly sourced. The serial numbers didn't match. The purity was slightly different. It raised a lot of uncomfortable questions about what allocated storage really means. This is why physical possession, or at minimum true allocated storage with regular audits and verification, is so important. Because when the system is under stress, paper claims and vague storage arrangements have a way of not working out the way you expected. Now let's talk about what's likely to happen next, because this is where the urgency comes in. We're heading into a period of significant geopolitical and economic uncertainty. The dollar's role as the global reserve currency is being actively challenged. The BRICS nations are working on alternative payment systems. Saudi Arabia is accepting yuan for oil. These aren't hypothetical future scenarios. This is happening right now. When the dollar's dominance erodes even slightly, gold benefits enormously, because gold is the ultimate neutral reserve asset. It's not anyone's liability. It doesn't depend on any government's promise. It's just metal. And in a multipolar world where trust between nations is breaking down, gold becomes the only thing everyone can agree on. Central banks understand this. That's why they're buying. They're not buying because they think gold is going to $3,000 or $5,000. They're buying because they need a reserve asset that isn't someone else's currency. They need something that will hold value regardless of what happens to the dollar, the euro, the yuan, or any other fiat currency. And here's the thing. When central banks buy, they don't sell. This isn't a trade for them. This is a strategic reserve allocation. That gold is going into vaults and it's staying there, which means it's coming out of the available supply permanently. Every ton that a central bank buys is a ton that's not available for anyone else. So you've got this massive, persistent bid from central banks. You've got declining mine production. You've got increasing industrial demand. And you've got a growing awareness among individual investors that the financial system is more fragile than they thought. All of this is converging at the same time. The paper market can suppress the price for a while. They can create selling pressure through futures contracts. They can manage the optics, but they can't create physical metal. And eventually, the physical market overwhelms the paper market. It's not a question of if, it's a question of when. My assessment, based on everything I'm seeing right now, is that we're very close to that inflection point. The divergence between paper and physical is already significant. The stress in the system is already visible if you know where to look. And the catalysts for a break are lining up. It could be a geopolitical event, a major conflict, a currency crisis, a sovereign default. It could be a technical event in the futures market, a failed delivery, a major short squeeze, a rule change that triggers a cascade. Or it could just be a gradual accumulation of pressure until something gives. But the direction is clear. If you own physical gold right now, you're positioned correctly for what's coming. But you need to understand that the game is changing. This isn't just about the dollar price going up. This is about physical gold repricing itself relative to paper claims. This is about scarcity becoming the dominant factor instead of just monetary policy and inflation expectations. Here's what you should be thinking about. First, make sure your gold is actually in your possession or in truly allocated, audited storage. Not pooled storage, not unallocated, not some vague arrangement where you have a claim on gold somewhere. Specific bars, specific serial numbers, regular audits, clear legal ownership. Second, understand that the premium you paid for your physical gold, that's not a cost. That's the price of certainty. That's the price of having actual metal instead of a paper promise. And as this divergence widens, that premium is going to look like the smartest money you ever spent. Third, be prepared for volatility. The paper price might drop. It might drop significantly. The commercial banks might engineer a sell-off to shake out weak hands. But if the physical premium stays high or gets higher during a paper price decline, that's actually a bullish sign. That means the physical market is disconnecting from the paper market. That means the real price, the price that matters, is the physical price, not the paper price. And fourth, think about this as a long-term strategic position, not a trade. The people who are going to benefit most from what's coming are the people who understand that physical gold is a form of insurance and a store of value, not a speculation. It's not about timing the market. It's about having real assets when paper assets fail. Look, I know this sounds dramatic. I know it sounds like doom and gloom. But I'm not making predictions based on fear or conspiracy theories. I'm looking at supply and demand. I'm looking at what central banks are doing. I'm looking at the structural mechanics of the gold market, and all of it is pointing in the same direction. The system we've had for the past 50 years, where paper gold and physical gold traded at essentially the same price, where you could convert between them freely, where the paper market set the price and the physical market followed, that system is breaking down. We're transitioning to a new system where physical gold trades at a premium to paper gold, where delivery is difficult and expensive, where ownership of real metal is what matters. This transition is going to create winners and losers. The winners are going to be the people who own physical metal. The losers are going to be the people who thought they owned gold, but actually owned paper claims that couldn't be converted to metal when it mattered. So if you own physical gold right now, hold on to it. Understand what you have. Understand why it's valuable. And understand that the next few months could be the period where everything we've been talking about, all these structural issues, all this building pressure, finally breaks into the open. This isn't about getting rich quick. This is about preserving wealth through a major transition in the global monetary system. This is about having real assets when the distinction between real and paper becomes the only thing that matters. And if you're positioned correctly, if you own physical gold, you're going to be very glad you made that decision when we look back on this period 5 or 10 years from now. The critical update is this. The divergence is accelerating, the pressure is building, and the timeline is compressing. What we thought might take years to play out is happening in months. The physical market is sending a very clear signal. The question is whether you're listening.